Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes on this wonderful Friday afternoon. Well, we had a slew of earnings this week, a lot of the financial stocks, and I do think that there are opportunities in the financial stocks. Interesting enough, Goldman Sachs, when we announced our trade that we did, we got fairly aggressively bullish, I would say, with a bull call spread. And then we adjusted the trade after the earnings announcement, after they blew the numbers out of the water. The market did go down, and it was very weird in the reaction in Goldman, in that Goldman has had a very strong move up over the last month. The market was a little toppy, sold off a little bit heading into earnings. After the earnings report, the stock initially ran up pretty aggressively, but during the trading session, the live trading session, the stock sold off. We adjusted our call, and then by the end of the day, the stock was up. And we did talk about that the path of least resistance in a stock like Goldman would be to the upside. Still trades at a decent PE, a decent PB, trading versus its book, and then we saw that in Citibank too. Citibank, we had we did a bull call spread also, and that stock did well. And then JP Morgan, we came out with JP Morgan, and I'm going to run to the Tradier Pro software right now. But in JP Morgan, we bought the 280 and we sold the 300. All these have August 1st expirations, because I did want to, in anticipation that they may sell off, like we saw in Netflix today, because of the big run up that all of these stocks have had over the last month or so. I wanted to give some room for the underlying stock to run. So JP Morgan has actually bounced back too and done pretty well. We did the 280, 300. We paid $8 for it. Our break even would have been 208, 288.07, $288.07. And we're at 289.93. So that trade right now is looking solid. We bought, and we put that one on first. That was the first trade that we looked at. Bought the 280, sold the 300. We've been profitable on this trade. You could have gotten out of it a couple of times, actually. And August 1st. Sorry about that. Here we go. Bought the 280, sold the 300. And right now we're at $11 on that trade, $2.90 or $10.90. So we're up $2 on the trade. You could do something similar that we did, and this is why I wanted to bring this up, is you could do something similar now that we only have 14 days remaining to expiration. You could get out of the trade. The trade has been profitable. There's been more than one time that we've had that opportunity. If I just pull up JP Morgan right now and we look at it, that stock has, well, I guess the highest that we got was 291. But we've been trading in that 280 to 290 level for quite some time, and we're now at 290, up 34 cents on the day. So if all the catalysts, well, not all the catalysts, there's still going to be some banks that are going to be announcing earnings, and I'm sure it's still going to affect JP Morgan. But if you wanted to, you could do something similar that we did to the Goldman Sachs trade on Wednesday. You can buy to close the 300 because we gave a lot of room for the underlying stock to run, and go down and say, okay, I don't need 300 anymore. I'm going to take a little bit of this profit that I have off of the table, right? And I'm going to buy to close that, and I'm going to sell something a little bit closer, because we've had a boatload of time decay in the 300 strike call option. And so we would actually have a profit on that at this point in time, even though the underlying stock has moved up. And then we roll it down and get more time decay when we put the position on. We initially put this on with about 30 days remaining until the expiration date. So how do we do that? Well, quite simply, this is your long option contract, and you're not going to touch that. You could close it out, and if you've had more than one opportunity to close it out at a very solid gain, or a decent gain, I shouldn't say. I don't want to imply that it was like we knocked it out of the park or anything. And if we close this leg, we're going to get rid of this leg, because don't forget we own it. And this would become a buy, and it would be a buy to close, but I'm going to click open because this is a test account. We're going to buy to close that, and we're going to sell this one. Oops. Okay, so we could bring in $1.35 net credit to the account. We still got 5 points of upside. The stock is at $290.39 right now. And we take $1.35 worth of risk off of our initial cost of $8. Gives us a little bit of a hedge if the market turns back. We got 14 days or so. What I would be looking to do on this position is when I get down to the final 7 days or so, I'm probably just going to take it off. So I like this scenario that you go in let's talk about the kind of hedge fund that we put together around earnings on the financials. I've been blunt about the fact that I've been bullish on the financials, own these stocks, let alone with trading options around them. You look to do a wide bull call spread if you want to get bullish on a stock that's about to announce earnings. If they announce earnings and the volatility comes out, so you're selling way out of the money option contract and getting a lot of premium because of implied volatility. If you're still bullish, if you still like them, then you roll that call option down and you bring in some more premium to try to set off a little bit of risk. Trying to make time decay on your long option not be an issue is really what your goal is, because you have to pay up for that pumped up implied volatility. Still bullish, still give yourself some room to run. So we're not going to do it with 1 week to expiration. Most of these trades went out about 30 days. Goldman Sachs and that, we were in the 20-day period. And now we're in that scenario again where JP Morgan is still looking fairly decent as far as momentum in the charts and everything that we've heard from the earnings, and reiterating that markets are loosening up, that there should be some more deals in the financial space. This is one of the stocks that should benefit from it, not to mention the volatility that actually got brought up because of all the headlines that have driven the market. And these stocks are they have traders. They have stocks that actually have investment banking and have trading services, and all of them have done really well across the board as far as trading is concerned. So that volatility usually benefits a lot of the institutions in the financial world, as long as the markets bounce back though too, because the bounce back helped too overall. I like that this trade. And so next week we have earnings that's going to happen. We have Google on Wednesday. We have Tesla on Wednesday, which is going to be a very interesting one. And I actually pulled up Coca-Cola because they announce on a Tuesday, and they're going to announce before the open on Tuesday. So we do have a Monday show, but Pepsi had such a strong earnings report. Pepsi did something. It was actually worth mentioning. Cancel that. Let's zoom out. Let's go days, and let's go 1,000 days. All right. Pepsi. I don't know why the chart's not working. And so just had solid movement in the underlying stock in Pepsi. Vol is all the way back down. Now we got Coke that's about ready to announce earnings, and they're going to be announcing on Tuesday before the open. Stock's trading at $70 right now. And, here's one of the things is implied volatility is 25 on the implied volatility. Historical vol is 18. So we are 7 points higher, but we're just not a ton higher on this position. But Coke, let's see if we can get that chart to come up. There we go. All right. So with Coke, we see this is the bump up in implied volatility on Coca-Cola, or I should say on the Pepsi move, and we're going into earnings. So the move has already kind of happened. So I kind of like actually selling some premium going into earnings. We had a pumped up implied volatility, but not a ton, not heavy implied volatility. But I wouldn't mind going out to the August 8th expiration and think that, all right, a lot of this move has already been put into the earnings report, mainly because obviously Coke and Pepsi usually have similar type results after their earnings report. So if we look at the earnings date, we're going to look to the August 8th expiration. But right now, the most at the money option contract is the 70 strike. We're going to buy. Let's look at the expected move after that earnings report. The expected move is about $2. So we're going to go beyond that. We're going to go out to the August 21st expiration. And I guess we'll sell. Well, we got to go out to the 28th if we want to get a little bit of premium. Yeah, here's what we want right here. We're going to sell the 72.50 and we're going to buy the 750. Okay, so let's sell this one and buy this one. Okay, so net credit. So we're going 2.5 points wide. We're bringing in a net credit of 45 cents. We're just outside of the expected move. We are going out further in time. We're going out about 28 days. Implied volatility, if we do see a crunch in the vol, we could see this thing dry up very quickly. If we don't, we've already had a big move up. If you're thinking that around earnings, the movement is $2 on the expected move. On this one day here in Coke, we went from on the low side 69.5 all the way up to 70. Yeah, almost 2 points, right? Well, a point, I guess, from high to low. So on this issue, we've already kind of had that type of move, a strong move, and we're bumping up against the 200-day moving average. Yeah, I like selling some premium in Coke because of the big run up in Pepsi already. So this is going to be a paper trade that we're going to put on. Coke is going to announce on the morning on Tuesday. So we can look at the trade on Monday before it's all said and done. But I don't want the stock to sell off a little bit too much. I'd rather put the trade on today. I'm not worried about major news events happening in Coke over the weekend. And that is going to be the official paper trade for this week. Now, there are some other stocks that are announcing earnings. Are there any requests that we want to look at as far as earnings are concerned? The big stocks, like I mentioned, on Wednesday, we got Alphabet, i.e. Google. We got Tesla. We have Capital One is going to be announcing, and that's going to be an interesting one to follow with their credit card business, see where that is at. They're announcing Tuesday after the close. The NASDAQ is announcing Thursday after the close. I expect them to, or on before the close, before they open on Thursday. And I expect them to have a good quarter too, mainly because of a lot of things that the banks have said. Let's see where the NASDAQ, but the NASDAQ options are a little tough. NDAQ. Well, we're above. We got all the ducks in a row. NASDAQ has been a real good stock. Like, look at if you bought the golden cross right here. Right here is where the 50 crossed over the 200. The stock hasn't really even looked back. Now we've kind of pulled off a little bit. We're trading at 89.35, right about where the 200-day moving average is at. Yeah, the NASDAQ might be interesting. Maybe we could look at a trade in the NASDAQ, probably similar to, just a little bit more worried about their option prices. 230, but 240. Yeah, that's not too bad. 20 cents wide on the 95. Fairly similar, a little bit and the implied volatility will probably come up quite a bit heading into this earnings report. But we'll see. We'll see. All right. Any other questions that we have or comments? Nope, I don't see any. Well, you guys have a great weekend. We still got earnings. This was, now we're going to get into a Netflix usually kicks off as usually the first company to announce earnings. Oh, by the way, and I guess I didn't even mention this, but the Netflix trade worked out great. We did it as an alternative to a short call spread. And so everything looks like it's going to expire worthless. Netflix had a solid quarter, a very good quarter. But once again, they took that opportunity to sell because the stock has gone up so much. It's down 5% on the day. We made our 60 cents. It's not even worth showing the options. The option contract that we bought was the 1,355 strike. So everything's way below that. That is trading for, a zero by a penny right now. And so you made your 60 cents. So you made your 6% on your $1,000. And then it would depend on how many contracts that you did. There was a $1,000 requirement per 1x2x1 skip, strike, butterfly. Thanks for stopping in. We'll see you Monday, and we'll look at some more earnings trades next week. And we'll hope to see you in the hub Monday morning, 11 a.m. Eastern time for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.